crypto long and short, licenses, liquidity, and the shifting geography of exchange quality. In this week's Crypto Long and Short newsletter, Joshua DeVos shares insights from a recent benchmark report on how the exchange landscape is maturing and becoming more execution-focused, but increasingly uneven as regional licensing diverges, liquidity fragments, and transparency advances inconsistently. Then, we take a look at where the digital assets market may be headed in the final weeks of 2025 with Andy Baehr's Vibe Check. Welcome to the institutional newsletter, Crypto Long and Short. This week, thanks for joining us. Alexandra Levis, by Francisco Memoria. Cryptocurrency prices dropped more than 13% over the past week, as measured via the performance of the CoinDesk 20 CD20 index, with Bitcoin BTC $89, 325.24, losing 12.6% of its value in the period. Yet, headlines tell us institutions aren't backing away. By Joshua DeVos, Research Lead, CoinDesk. For years, Europe looked like the natural center of gravity for crypto regulation. Clearer frameworks, early VASP regimes, and a maturing supervisory environment made the EU feel like the region ready to dominate licensing and registration. But as MiCA moves deeper into its implementation phase, we're seeing a new trend in the underlying registrations. The center of gravity is shifting, and it is shifting towards the US. The latest edition of CoinDesk's exchange benchmark makes this clear. For the first time in several cycles, courtesy of data from VSPNet, North America has overtaken Europe as the top licensing region for digital asset exchanges, based on the number of benchmarked exchanges duly licensed/registered under these jurisdictions. The U.S. regulatory model is often described as fragmented or slow, but it is proving to be more stable and functional than many expected. Exchanges are now treating FinCEN registration and a network of money transmitter licenses as a workable route to legitimacy. Europe is moving in a different direction. Increasingly strict rules are creating difficulties for some of its own VASPs. VASPNet's data suggests that the end of the MiCA grandfathering periods is putting pressure on mid-sized firms that were comfortable under previous national regimes. The result is consolidation, and in some cases, a shift of business operations toward more permissive jurisdictions. The data reinforces the trend. The direction of travel is becoming clearer. Exchanges are concentrating in regions where licensing is still practical and commercially viable for them. Liquidity. Why execution has become the real signal. The benchmark also introduced the most significant market quality update since its launch. Historically, liquidity assessments have relied heavily on static order book depth. While simple to measure, displayed depth is often divorced from real execution conditions. Stale liquidity, spoofing, and inconsistent refresh rates limit its usefulness as an indicator of market quality. This year's framework shifts the analysis toward executed trades rather than displayed orders. The new composite liquidity score draws on. The principle is straightforward. Liquidity should reflect actual execution conditions, not what appears in the order book. This shift happens at a moment when market structure itself is changing. Top-tier exchanges no longer dominate global spot volumes the way they did over the last few years. In Q1 of this year, the top tier captured nearly 60% of market share of volumes. In Q3, that figure is 41%. Liquidity is becoming more distributed, and execution quality is now a clearer differentiator than raw size. The exchanges that rise to the top under this more rigorous, execution-driven approach are also strengthening their regulatory footprints. Binance, Bitstamp, Coinbase, Kraken, and Crypto.com all score highly here. Regulation and genuine execution quality are becoming increasingly aligned, where exchanges are still lagging. Despite clear progress, the benchmark highlights several areas where the industry continues to fall short. Overall, the exchange landscape is becoming more mature and more execution-focused, while also becoming more uneven. Regional licensing standards are diverging. Liquidity is fragmenting. Transparency is progressing in some areas and stalling in others. The benchmark shows what high quality now looks like. Exchanges that get these right are driving the continued divergence amongst our benchmark universe. By Andy Baehr, CFA, Head of Product and Research, CoinDesk Indices. With precious few weeks left, What will the digital asset class deliver in 2025? Over the weekend, Bitcoin plummeted below its year-open price of around $93,400. Of course, we remain far from 2025's lows, below $75,000 in early April. But with fewer than 7 weeks remaining, we wonder what message 2025 will end up delivering. This was meant to be, and in many ways has been, the year when crypto got permission. We think it's fair to say that the U.S. administration has done its part, both in terms of prompting regulatory progress and some legislative results. Wells notice futures tanked. Most observers agree that it's the markets that have erased crypto's impressive gains in Q2 and Q3. Lack of certainty, lack of liquidity, and lack of catalysts. Even lack of data. There is some irony that the U.S. government did more to depress crypto prices by being shut than by being open. And let's make no mistake, crypto has more to prove. If a sour market takes the shine off of growth equities in 2025, well, such is the game. There's always next year. For the young digital asset class, striving to earn allocations by global investors, a bad year is more off-putting. Crypto risks delivering poor 2025 results. A few hopeful signals. There is no lack of good news about the adoption of blockchain technology and its integration into the global financial system. We have referred to this as the slow money, M&A, new launches, IPOs, etc. Yet, we don't see consistent conversion of that progress in digital asset market returns. Where we do see encouraging signs is in the quality of those trading markets. Breadth, as always, is key. When we look at our two flagship market indices, CoinDesk 5 and CoinDesk 20, we see that they have held on relatively well in Bitcoin terms. We observe a cull of distracting assets. Smaller names and frenziera memecoins subsided steadily in 2025, allowing the market to train its focus on a more reasonable beta. Bitcoin closed last week down 10% at $94,244. This marked the largest weekly decline in the BTC price since the week ending March 9th. This also recorded a third consecutive week of negative Bitcoin price action. Bitcoin has since traded below its yearly open and is on track to record 4 consecutive weeks of negative price action, which would be the first time since the first week of July 2024. The top headlines institutions should read by Francisco Memoria. Insights and analysis on global exchanges by Joshua DeVos. Crypto's hopeful signals. As we end out the year by Andy Baehr. Bitcoin's 2025 weekly returns in chart of the week. JP Morgan launches institutional deposit token JPMD on Coinbase Space. JP Morgan rolled out its USD deposit token, JPMD, to institutional clients on Coinbase Layer 2 network base. Diversification, not hype, now drives digital asset investing. Sygnum. Swiss crypto bank Sygnum's 2025 Future Finance Report found portfolio diversification, 57%, has overtaken short-term returns as the top reason institutions allocate to digital assets. Harvard Endowment takes rare leap into Bitcoin with $443 million bet on. BlackRock's IBIT, Harvard University's endowment, revealed a massive 6.8 million share stake in BlackRock's spot Bitcoin ETF IBIT, worth around $443 million and representing roughly 20% of its reported U.S. public equity holdings. Visa tests stablecoin payouts to speed payments for creators. Gig workers. Visa Direct now enables businesses to fund payouts in fiat while recipients receive USD-backed stablecoins, e.g. USDC, directly to wallets for near-instant, cross-border access. Tokyo Exchange Operator. Mulls limits on digital asset treasury firms. The Tokyo Stock Exchange Operator, JPX, is reportedly exploring stricter rules, including backdoor listing restrictions and mandatory audits, to curb listed companies pivoting to large-scale Bitcoin/crypto treasuries, DATs. EU registrations fell 33% since April. The Netherlands saw an 83% drop after its transition period ended. Only 16 exchanges currently hold MiCA authorization. Meanwhile, 59% of global exchanges are now regulated under a broader virtual asset or market regime, up from the last cycle. Realized slippagean execution-based depth proxy trade density sustained trading activity across the top 25 pairs. Only 34% of exchanges publish audited financial statements. Only 49% provide proof of reserves and 35% provide proof of liabilities. Security losses reached $62 million during the assessment period, although more exchanges now operate formal bug bounty programs. Licensing that enables access to markets liquidity that reflects genuine execution conditions transparency that supports institutional-grade expectations. CoinDesk 5 is just about flat in Bitcoin terms, down less than 2% YTD. CoinDesk 20 is only down 8.4% YTD in Bitcoin terms, and is dead even year-on-year. The CoinDesk 8080 names outside the CoinDesk 20 lost half its value in CD20 terms. The CoinDesk Memecoin Index, CME, which tracks 50 memecoins equally weighted, lost more than 60% of its value in CD20 terms. Listen, XRP ETF sets new 2025 launch record with $58 million debut. Read. Standard Chartered's Jeffrey Kendrick says Bitcoin's steep decline is part of a recurring pattern. Watch. Galaxy Digital founder and CEO Mike Novogratz discusses why the $38 trillion national debt has created a golden era for crypto. Engage. The first wave of speakers for Consensus Miami has arrived. Register by November 21st to save up to $1,200 on walk-up prices.